Welcome to another one of our Money Talks video talks with me, Jerry Slusowitz, President of Pacific Financial Planners. Here to talk about your money and the markets, kind of give you an update of where we are today on March 8th, 2011. Well, the markets kind of peaked out near term on February 18th, S&P 1344, and kind of bottomed out at 1294 on February 18th. Since then, approximately 9 trading days, we've been kind of trading in that range like a yo-yo, kind of forming a pennant, if you will, or a triangle, and those are trend-ending formations. So we're going to get to the end of this trend at some point in time where it narrows down, and eventually the market's going to break either way. It could break back up and take out those old highs of February 18th above 1344, or it's going to break down. Either direction, I anticipate about 50 S&P points as a minimum on the move on that breakout from our near-term pattern. When that'll happen, I don't know. I mean, it could happen very shortly. It could take a little while. But whether you're looking at the Dow, the S&P, the NASDAQ, or the Russell 2000, or the mid-cap index, all those main indicators are forming that. There are a couple sectors that look pretty good. Utilities and energy are still doing well. Obviously, oil's done extremely well. Gold and silver are okay. But we're in a situation where it's a very dynamic, very fluid situation depending on oil. We have our own Fed Chairman Alan Greenspan, or geez, a slip of the tongue there, Ben Bernanke, dating myself here. Ben Bernanke stating, hey, look, this oil problem is limited, and because it's a supply issue, not a demand issue, it'll be temporary. And I hope he's right, and it could very well be. And if you look at other economic fundamentals, things like corporate earnings, even unemployment is starting to improve, consumer confidence, consumer spending. There's a lot of reasons why this market could be dynamic to the upside and continue the market rally that we started approximately 2 years ago. So there's a lot of good things out there on the market and on the economy. However, this oil does have the ability to knock us off our perch. It is a very shaky, government-driven recovery that we're in. It's because of government stimulus, huge amounts of cash being pumped into the system on a daily basis, almost $4 to $5 billion on average with this, what they call QE2, quantitative easing number 2. It's where the Federal Reserve is basically monetizing our debt. They're buying treasuries from the primary broker-dealers, the 17, 18 primary broker-dealers, the names you're all familiar with, Goldman Sachs, Morgan Stanley, etc. And what they're doing is they're buying treasuries from them at a profit. That money's coming in daily, because these POMOs are almost daily, these permanent open market operations, and that money's finding its way to support the stock market, which is giving people confidence in the economy. That is exactly what Ben Bernanke wanted, and he's being successful. However, oil acts as a tax on Americans. Out here in California, we're $4 a gallon. I mean, so when they're talking about approaching $4 a gallon, we're at $4 a gallon out here where I live in terms of gas. Now, some of that is state tax, etc. But when you're paying that kind of money to fill your tank, it acts as a tax on ordinary citizens. People slow down their driving, they slow down their spending, as well as transportation costs increase. Some of the food costs that we've seen huge increases in food and goods that are being transported around the globe or across the country. The costs of those are being passed on. That is inflationary. Higher prices could re-stagnate the economy. They say there's nothing better for a cure for higher prices than higher prices, because what it does is it causes people to cut demand by cutting spending, which would slow down the economy. So we're in this yin-yang situation. Which way we go, it's not quite clear. We'll update this video as soon as we get more of a clear break, but for now we're in a trading range. It's very important to use stop losses, protect your capital, protect each position where you have profits. New purchases, you know, you've got to really be confident. Things like I said, healthcare, energy are working, utilities are working, but it's a matter of, are things really looking better than they did, you know, a week ago, or are things really better and on the mend on a bigger uptrend? Remains to be seen, because there's things like this Friday, the 11th, a national day of protest in Saudi Arabia. I think that holds the key. Saudi Arabia, maybe Pakistan, holds the key to the success. If that goes well to where there's no protest, that gets out of hand and it doesn't lead to more protests and people just kind of go home and say, well, we've had our peace, we could see oil prices drop back down to the $80, $85 level as they were before this whole fiasco started in the Middle East, and the economy will probably continue to take off, and stocks will probably go back to the 2007 highs, and we'll participate in that. Right now we're playing both sides of the market, trying to be protective, because that's the best and most prudent way to be. If you've got any questions, you want to sign up for our free email newsletter, right up above me here it says free educational newsletter. Just all we need is your email address. Click on that, or if you'd like to have a free portfolio review, call my office toll free 800-449-9501. That's toll free 800-449-9501, and we'll update you again shortly.